Good morning, ladies and gentlemen, and welcome. It is really great to be able to connect with you online again, like we're doing now. When it comes to our financial wealth, it's important to remember that every financial decision we make affects our ability to protect what's important to us and to achieve our financial goals and aspirations. And that's precisely why at Nedbank Private Wealth and Nedbank Financial Planning, we use our globally integrated advice-led approach to enable you to connect your financial decisions to your life goals and aspirations. And practically what this means is that we provide our clients with technical expertise, appropriate opportunities, global solutions and services across Nedbank and other institutions. But most importantly, we connect you to enable you to be able to make better financial decisions and avoid financial disasters. And in essence, this is what we refer to when we talk about connected wealth. In today's webinar, we're going to be unpacking the estate and tax planning aspects that you need to consider if you want to structure your financial wealth optimally. And to do so, I'm really excited that we've got the rest of the Fiduciary Advisory team online joining us today. So just very briefly to introduce you to the team, first up we have Akorna Modi, who is an estate planning paraplanner based in our Cape Town office. Morning, Akorna. Looks like we got a little bit of a connection problem there, so we'll move over. We have David Jordan, who is based in our Cape Town office as well. Morning, David.
Good morning, Tracy. Good morning, everyone.
We have Debs Moodley, who is based in our Johannesburg office. Morning, Debs.
Morning, Tracy. Good morning, everyone.
And we have Ilana Oosthuizen, who is also based in Johannesburg. Morning, Ilana.
Morning, Tracy. Morning, everyone.
And we have Hanneli Lagrange, who's based in Cape Town.
Good morning.
Priscilla Reddy, who is based in KZN.
Good morning, ladies and gentlemen.
And last but by no means least, we have William Kwela, who is our senior tax specialist. Morning, William.
Morning, Tracy, and morning, everyone.
Great. So if we look at the format of today's session, I'm going to shortly be handing over to Devs and Hanneli, who are going to take us through a presentation. And really the purpose of that presentation is just to try and get our thought process going in terms of what are the estate and tax planning considerations that we need to bear in mind if we are looking to optimally structure our financial wealth. And after that presentation, we're going to have a Q&A session. That's when I'm going to be joined once again by the greater team. And we really invite everyone that's online to please make use of the Q&A function that's on the right-hand side of your screen, because really we'd like to make this more of an interactive engagement conversation type session more than an hour-long webinar where we are presenting. So please do make use of that Q&A function. So just some brief housekeeping. In the next few days, you will receive an email. It will contain a link to the recording of this webinar. So if you'd like to watch it again or share it with friends and family, you'll be able to do so. Once again, please, I invite you to make use of the chat function and to pose us your questions or comments as we go through the presentation. So really, without any further ado, I'm going to be now handing over to Devs and Hanneli to take us through the presentation. And we're going to be starting with Hanneli. So Hanneli, over to you.
Thank you, Tracy, and a good morning again to everyone. As Tracy mentioned, a critical part of sound wealth management is ensuring that your worldwide investments are structured optimally. When we're referring to structuring in this context, we're essentially referring to two specific aspects, namely one, the legal ownership of your investments, and then two, the nature of your investments as it relates to estate and tax planning. Keep in mind, however, that the purpose of the session is to look at the estate and tax planning considerations in respect of various investment options and not necessarily to unpack the traditional investment-related aspects. Let's have a quick look then at the agenda for today. So first, we'll recap on the general estate and tax planning considerations. We'll then provide a summary of the estate and tax planning consequences of certain frequently used investments. We'll also work through a particular set of facts, the applicable estate and tax planning consequences, and some of the considerations to structure the relevant investments more efficiently. In conclusion then, we'll provide some guidance in terms of the way forward. Let's start by recapping on the basic principles. So as is illustrated with this picture, an estate is a living thing, meaning it's accumulated during one's lifetime but could be impacted by certain life events such as marriage, birth of a child, divorce or death. One should therefore plan one's estate for both during and after one's lifetime. Let's also recap then on the general estate and tax planning considerations as set out on the next slide. Starting at the top is continuity. This is the extent to which significant events such as incapacity, sequestration or death can actually disrupt the continued management of or access to investments. Moving to the right then is the effective distribution of assets after death, which refers to the process, cost and time frame related to how investments will be distributed after death. Protection for your dependents is the extent to which minors or those with disabilities are financially protected, and to which education planning and intergenerational wealth transfer is enabled. Protection of assets from seizure refers to the level of protection from sovereign or creditor risks. Tax cost and administration implications is the applicable taxes and tax disclosures that stem from the investments you own. And then flexibility refers to the extent to which changes in your personal circumstances or then regulations and best practice over time are provided for. Bringing this all together then, what does estate and tax planning actually involve? Estate and tax planning includes, amongst other things, structuring your wealth optimally for both during your lifetime and after your death, as well as understanding the tax consequences of the legal ownership options and the products you use. You may then also ask why estate planning is important. As is seen from the next slide, estate and tax planning is important as it provides you with peace of mind that your wealth is structured efficiently and will devolve as you intended if you pass away. It also ensures that there are no unnecessary delays in any payouts and minimizes costs such as taxes, which in turn promotes wealth creation and preservation. I will now be handing over to my colleague Debs, who will be taking you through the estate and tax planning consequences of certain frequently used investments. Over to you, Debs.
Thanks, Hadley. If we consider South African individuals with exposure to South African and international financial instruments, each instrument could have a different impact on your estate, both during your lifetime and on death. You should always consult with a wealth manager and an investment specialist in order to determine the investments or combination of investments which would best suit you. Now to the tax implications. In this presentation, our focus will be on the high-level tax and estate implications of various investment products. We have summarized in this slide some of the tax consequences of the more frequently used investment products. With regard to endowments, these are taxed within the wrapper in terms of the five-fund approach. Essentially, any income earned is taxed at a reduced rate of 30%, and capital gain is taxed at an effective rate of 12%. From an estate duty perspective, the endowment will be an asset in your estate and will be subject to estate duty. But where a beneficiary has been nominated, there will be no executor's fees. With regard to retirement funds, retirement fund withdrawals are taxed in terms of the retirement tax tables and are not subject to estate duty or executor's fees. The funds, however, are subject to the fund rules and to Section 37C of the Pension Fund Act. This essentially means that the trustees of the fund will decide on the distribution of the funds on death. With a tax-free investment or tax-free savings account, on the other hand, the investment is tax-free during your lifetime as long as the investment is within the allowable thresholds. The investment will be subject to estate duty as it is an asset in your estate, and certain tax-free savings accounts allow you to nominate a beneficiary, in which event no executor's fees will be applicable. With a fund of fund or multi-fund from an international perspective, income tax will only be triggered if the fund declares an income. There will be capital gains tax on amounts not retained within the fund. There will also be capital gains tax if you sell units. However, moves within the fund by the fund manager will not be subject to capital gains tax. If we look at a single fund, i.e. your unit trust, if you switch between funds or sell units, capital gains tax will be triggered. You will be subject to income tax only if the fund declares an income, and the investment will be subject to estate duty and executor's fees. If you hold an investment portfolio comprising of various investment instruments, on the other hand, income earned from the portfolio will be subject to income tax. Any dividend you receive will be subject to dividend tax or dividend withholding tax, and any disposals relating to the investment itself will be subject to capital gains tax. The investment will be an asset in your estate and will be subject to estate duty and executor's fees. From an international tax perspective, with an international investment portfolio, certain CITES taxes may apply, and one would then need to look at any double tax agreement in place for relief. Now let's have a look at the estate consequences of these products. Assuming an individual holds these investments in his or her personal name, an endowment, we see that you have continuity and you have effective distribution after death, as you can nominate a beneficiary. The proceeds and ownership will be transferred to the nominated beneficiary on death. Endowment will be assets in your estate. An endowment will be assets in your estate and will be subject to estate duty. However, if you nominate an inter vivos trust, for example, as a beneficiary in your endowment policy, proceeds will go straight to the trust for the benefit of the beneficiaries, thus offering a degree of protection. From a flexibility perspective, endowments are not flexible within the lock-in minimum investment period. Flexibility only kicks in once the minimum investment period is over. If we have a look at retirement funds, we can see from the ticks and crosses on the slide that retirement funds offer you continuity, effective distribution after death, and protection for dependents to an extent that you can nominate a beneficiary on the retirement fund. Retirement funds will not be assets in your estate for estate duty purposes, and they will not be subject to executor's fees. Retirement funds, however, offer no protection in respect of the sovereign, but can offer some protection in respect of creditors. Moving on to a tax-free savings account. We see that when no beneficiary nomination is offered, these offer no continuity, no effective distribution on death, and the account will have to go through the estate administration process. If a beneficiary is nominated, it will allow for continuity, it will allow for protection on death, as the ownership of the actual savings account will be transferred to the nominated beneficiary. However, in both instances, the account is an asset in your estate and will be subject to estate duty. Unfortunately, with these kinds of investments, there is no protection from seizure, and the investment will only be tax-free within specific limits. If we have a look at your investment portfolios, your fund of funds, your single funds, or your multi-funds from an international perspective, All of these types of investments will be assets in your estate and subject to estate duty. The investments do not offer much from the perspective of continuity, effective distribution after death, or protection for dependents. The investment will have to go through the estate administration process. Unfortunately, these investments offer no protection from seizure as they are assets that are legally owned in your personal capacity. Next slide, please. As mentioned previously, the best option for you will depend on your individual circumstances and intentions. At this point, I'd like to highlight that each of the investment products we mentioned can actually be held in different ways, namely in your sole name, in a joint name in limited instances, in multiple names in limited instances, or through structures such as a trust, a company, or a combination of a trust and company. The tax and estate planning considerations for each ownership option should always be considered. Hanneli will now be taking us through the facts of a case study we put together to illustrate the estate and tax consequences of different legal, ownership, and investment options. Over to you, Hanneli.
Thank you, Devs. To confirm, our focus for today will then be on the estate and tax planning consequences of assets obtained with discretionary savings, as opposed to compulsory savings in retirement products. As Devs mentioned, use of a particular set of facts in order to illustrate this, as is set out in the next slide. So please meet Andy, a 43-year-old businessman living in Sandton. He has a 9-year-old son, Scott, with his girlfriend, Julia, who Andy has been dating for the last 15 years and is currently a stay-at-home mom. He has a valid will, which deals with the transfer of his worldwide investments after his death. In terms of this will, he leaves his primary residence to Julia and the residue to Scott, provided that if Scott is under the age of majority at the time of Andy's death, his inheritance should be held in an SA testamentary trust until he reaches that age. Andy earns a relatively good salary from his current position and has been able to, over the years, build his wealth. He currently owns the following investments: a house in Parkmore, which is his primary residence, a rental property in Camps Bay, shares and bonds in South Africa, and international shares and unit trusts held through an international banking and investment platform. Andy is concerned that he's paying excessive taxes in respect of his investments, as he is already in the highest South African income tax bracket as a result of the salary he earns. He is further unsure if his son and girlfriend would be adequately provided for after his death, considering that all his investments are held in his personal name. In addition, with regards to his international account, and his banker mentioned that he could consider holding the account in joint names with his son, but Andy is unfamiliar with this type of ownership. Devs will now take us through the estate and tax planning considerations in respect of Andy's current investments. Over to you, Devs.
Thanks, Hanneli. Next slide, please. Having consideration to the pillars of estate planning, we see that in Andy's current circumstances, there is no continuity or protection from seizure, as all Andy's investments are held in his sole name. Access to these assets will therefore be interrupted in the case of incapacity, sequestration, or death. There will be a delay in the distribution of assets after Andy's death, as the assets will form part of Andy's estate and ownership will be distributed according to Andy's will. Although there is a degree of protection for Andy's minor son through the use of a testamentary trust in Andy's will, the estate administration process will still need to be followed. And with regard to his international investments, depending on the Reserve Bank provisions at the time of Andy's death, the executor may need to repatriate some of his international investments in order for the South African Testamentary Trust to hold these. His current ownership structure, however, does allow for some flexibility, as Andy will be able to vary his holdings depending on his circumstances. Next slide, please. So now we look at Andy's current investments from a tax perspective, and specifically his fixed property. The distinction needs to be made between his primary residence and his investment property. With regard to his primary residence, there will be no taxable income generation unless Andy rents out a portion of the property. All costs incurred in relation to the property are personal in nature and not deductible for income tax purposes. This disposal of the property will, however, trigger capital gains tax, but Andy has access to the 2 million rand primary residence exclusion. With regard to his investment property, however, any rental income will be taxable in his hands at the marginal tax rate. Certain expenses incurred will be deductible from his taxable income, and capital gains tax will be triggered on the disposal of the property. However, unfortunately, Andy will not have access to any 2 million rand exclusion, as this is only applicable to a primary residence. As both of Andy's properties are South African fixed properties, each can be dealt with in terms of his South African will. Next slide, please. With regard to Andy's other investments, from a tax perspective, Andy will be taxed on all income received from the investment in the form of interest or dividends and capital gains on the disposal of any asset. On death, capital gains tax and estate duty will also apply. Andy should, however, be allowed to make use of the available tax income thresholds, capital gains exclusions, and estate duty exemptions. If Andy holds UK or US situated or CITES assets, he may become liable for various forms of tax in the UK or the US. Tax relief may, however, be possible in terms of a double tax agreement between South Africa and the relevant jurisdiction in which Andy holds assets. Andy, however, is responsible for taking care of any tax administration requirements and for keeping accurate records, since he holds all of these assets in his personal capacity. Hanali will now highlight some considerations for Andy. Over to you, Hanali.
Thanks, Steve. Having looked at the current estate and tax planning consequences of Andy's investments, let's now turn to the next slide, setting out some of the considerations for him to ensure that his estate is structured optimally for both during and after his lifetime. Keeping in mind, however, that these considerations are specific to Andy's needs and circumstances. For Andy, some of the considerations would include the following: whether to have one will dealing with his worldwide investments, or to amend his will to only deal with his South African investments, and to prepare a separate international will for his international investments. Whether to retain his investments in his personal name, or to make use of structures such as a trust, or an investment vehicle such as an endowment. Whether to make use of a different investment option, such as a fund of funds in the South African context, or a multi-fund internationally, and then whether to add his son as a joint holder of his international account. In the next slide, we highlight some of the differences in the estate and tax planning consequences of Andy's current financial investments versus the possible investment options to consider in order for Andy to achieve the desired tax efficiency, ease of administration of his estate after his death, and protection of his minor child. So as we see on this slide, the main advantage of using single funds, as we see in the second column, or then fund of funds or a multi-fund as per column 3, over direct shareholding on the far left, is essentially from a tax efficiency point of view. As was mentioned earlier, using a fund would mean that Andy would only be subject to income tax if the fund declares an income. The use of a fund of funds or multi-fund would create further efficiencies from a tax perspective, considering that CGT will only be triggered if units or shares are sold in the main fund, instead of when switches occur between underlying funds. Making use of an endowment, as per column 4, would be even more tax efficient for Andy, considering that investments housed in an endowment will be taxed according to the lower rates as per the 5 funds approach, and CITES taxes would not apply, as mentioned before. Another advantage of an endowment is that it provides continuity and ease of administration after Andy's death, considering that ownership will be transferred to his nominated beneficiary. There could also be protection for Andy's son, who is still a minor, if Andy makes use of a dormant inter vivos trust and nominates such trust as the beneficiary on the endowment. With regards to Andy's international investment, joint ownership could also be considered. Appointing his son as joint holder would provide similar benefits to housing it in international endowment, since ownership would be transferred after Andy's death by way of the right of survivorship. However, the same tax efficiency would not apply as with the international endowment, and he would not be able to provide for the same protection for his son while he's a minor. Another alternative could be for Andy to make use of a structure, such as a trust. Let's now have a look at how this would work on the next slide. Andy would first establish a new trust in the relevant jurisdiction, and in the process appoint trustees, agree the terms of the trust deed, and prepare a letter of wishes. He would then transfer the applicable investments held in his personal name to the new trust, either by way of donation or on loan account. The result would then be that the trustees hold and manage those investments with effect from the date of transfer, and that would be for the benefit of the discretionary beneficiaries named in the trust deed, which would be Andy and his family. In the next slide, we highlight the differences in the estate and tax planning consequences of utilizing the trust structure compared to the other investment options already mentioned. As we see on the far right, there are several advantages of utilizing a trust, which is mainly due to the trustees being regarded as the legal owner of the investments, i.e. the fact that such investments should not form part of Andy's personal estate. The use of a trust could also be tax efficient for Andy, but this would depend on a number of factors, such as the applicable taxes on transferring personally held investments to the trust, whether trust income and gains will be vested in discretionary beneficiaries or retained in the trust over tax year end, and the applicable CITES taxes in the international context, and the list goes on. It is important to keep in mind, however, that a trust should not be utilized with the sole purpose of obtaining a tax benefit, but instead the traditional benefits associated with such structure, as we see on the slide, should also be considered. All of these benefits should then be weighed up against the costs involved and a decision be made accordingly. Over to you, Devs.
Thanks, Hanneli. Next slide, please. As a few key points to take away from this presentation, ladies and gentlemen, it is essential to ensure an appropriate mix between the chosen ownership options and the investment solutions. It is of particular importance, therefore, to consider all associated costs and to conduct a cost-to-benefit analysis when selecting the appropriate mix. Generally speaking, however, the tax tail should not wag the investment dog. Careful consideration of all the estate and tax planning considerations relevant to each individual's particular needs and circumstances are key. There is no one size that fits all. To ensure you consider all the variables relating to both your personal situation as well as all the relevant regulations and tax legislations that apply, it is important to get professional advice on how to structure your financial wealth optimally. Back to you, Tracy.
Great. Thanks, Devs. Thanks, Hanneli. I think definitely a lot of food for thought in that presentation. And I think if I can, just very briefly, some of the key takeouts that kind of stood out for me I think, the first thing in one of your last bullet points there, Devs, you mentioned that, two key components of sound financial planning. The one is looking at it from a structuring perspective, and the other one is looking at it from a selection of appropriate investment solutions. And obviously the purpose of this webinar today is to discuss the former, looking at it from a structuring perspective. But really, if we're looking at it from a structuring perspective, there's two things. The one is choosing the right legal ownership option in which to house your financial wealth. And then the other one would be when it does come to selecting the right investment solutions to meet the investment objectives, it would be around understanding what is the nature of the structure of that investment, because obviously there will be tax consequences linked to that. I think very importantly though, I mean, you said, Devs, it's about getting the right mix between those two things, and that one should not allow the tax tail to wag the investment dog. I think the other thing that stood out for me, estate planning is planning for both during and after one's lifetime. I think we so often forget the fact that we need to make sure we have appropriate structures both during our lifetime as well as after. And I think another point, proper estate planning is important, and it provides us with that much needed. And I guess if we look at the current kind of roller coaster environment we find ourselves in with the pandemic, proper estate planning does provide us with that much needed peace of mind that our wealth has been optimally structured. You did touch on the fact, Hanani, that a will is an important estate planning tool, and it always amazes me how undervalued a will is actually, but it is one of the most important estate planning tools that we can all have, because effectively it does become our voice when we no longer have one. You touched on the fact that endowments under the right circumstances can be an efficient investment solution. Also, from a trust perspective, under the right circumstances, trusts remain an effective estate planning tool as well. But I guess you summed it up as well when you said that there is no one size fits all. And that's why it is important for our clients that are joining us today to really reach out to your wealth advisor so that we can make sure that we take your particular circumstances into account in order to ensure that you have the right structure. So again, Devs, Hanali, thank you so much. I think that really gave everyone online some food for thought. And so I think moving over now, and we're going to go into a Q&A section. So if I could have the next slide, please, it will be the Q&A. And just really during this Q&A session, what we're going to be doing is addressing the questions that have come through on the chat. So that to those clients that have posted questions, thank you. And to everyone, please continue to post your questions because we'd really like to try and address any concerns or questions that you may have. So please reach out to us, make use of that chat function. So I think if we start off, and I see there is one question, I'm going to start on trusts. So David, I'm actually going to be addressing this question to you, please. So I think it was Devs or Hanali, touched on the fact that trust can be an effective or a viable estate planning tool. But one of the things that we often come across with clients is that they say, that the taxes can become quite complex. So David, perhaps you could just very briefly talk us through what are some of the tax consequences of a trust that a South African resident should consider.
Yes, Tracy, thanks. Well, typically, when an estate planner wants to establish a trust and wants to fund the trust, depending on the nature of the asset that would fund the trust, if it's cash, the planner would typically donate the asset to the trust, or the planner could enter into a loan agreement with the trust. If it is an asset, yet again, the planner can physically donate the asset or sell the asset to the trust on loan account. Now, depending on the nature of that kind of asset, if that asset is, for example, immovable property, then transfer duty is also payable. If the asset that is transferred to the trust, for example, shares, then there could be securities transfer tax payable. Then, of course, The other thing is, if it's an asset that is donated, the donation of that asset is a disposal for CGT purposes. So there may be capital gains tax payable on the actual transfer of the asset or the transaction that the planner enters into with the trust. If it's cash, of course, then there's no capital gains tax payable. Now, the consequences of that, if a planner donates cash or assets to a trust, donations tax is payable. And donations tax currently, the rate is 20% on the first 30 million and 25% in excess of that. If the planner wants to avoid the donations tax, of course, then as we said, then he would probably rather transfer the asset on loan account. Now, if the transaction is entered into loan account, yet again, the planner can either charge interest on the loan, or the interest could be a low form of interest or no interest. If the planner charges interest on the loan, then of course he has to disclose that interest in his tax return, and it becomes taxable. If it's a low interest or no interest transaction, then you enter into the realm of what we call the attribution rules, and that has certain consequences. For example, if the income then is any income that is earned in the trust that's linked to that non-charging of interest or that gratuitous disposition, will be taxable in the hands of the planner. If the planner charges, yet again, also no or low interest loan, there could be also, it will be a deemed donation on the foregone portion of the interest not charged, and that's also then taxable on an annual event. So I think the important thing here is, there are many tax consequences and there are many ways how to get assets into a trust, and it's not one size fits all. So one would always have to consult someone and determine in this particular set of facts what route to follow and what will have the least tax impact if one considers setting up a trust. Tracy, back to you.
Thanks, David. So, I guess, it can become quite technical from a tax perspective, but I guess the bottom line is one's always got to do that kind of cost to benefit analysis. So taxes are a cost, and one's got to weigh up what are those costs against the benefits that one would achieve by utilizing a trust structure. So another question that's come through, and Ilana, sorry, I'm going to pose this one to you. It's quite an interesting one. It says in the presentation, it was mentioned that a tax-free savings account forms part of a deceased estate and is subject to estate duty. How is this so, as it's meant to be tax-free?
Thank you, Tracy. Although, as you rightly mentioned, the tax-free savings account is tax-free during a client's lifetime, obviously provided the annual contribution limits of 36,000 and a lifetime limit of 500,000 per person are abided by. On death, however, the situation is different. The proceeds of the tax-free savings account, i.e. the deposits and all returns earned prior to death, will form part of property as defined by the Estate Duty Act, and that means basically that following the death of the holder of this tax-free savings account, estate duty will be levied on this amount. It's also important to point out that even if you nominate a beneficiary on that tax-free savings account, it will still be subject to estate duty. However, keep in mind, like for instance, the 4Q deduction between spouses will still be applicable. Thank you, Tracy. Back to you.
Thanks, Ilana. Okay, and we've got another question that's coming in here in terms of wills. And Priscilla, I think I'm just going to pose this one to you, if I may. In what circumstances would one need to have a separate international will drafted?
Tracy here, if a client owns assets in countries that follow a civil law system, it would be advisable to have a separate offshore will. These countries do not recognize total freedom of testation, and forced heirship is generally a feature of civil law legal systems. So it would therefore be prudent to draft a will that incorporates the laws of that specific country. In other instances, for ease of administration, simultaneous administration of your South African estate and your offshore estate. So beneficiaries do not have to wait for the South African estate to be finalized before they receive the benefit from an offshore asset. And that would be, for example, a direct offshore portfolio. Thank you, Tracy. Over to you.
Thanks, Priscilla. So, I mean, I guess once again, the key message there is to speak to one's wealth advisor to make sure and determine exactly when one would need a separate will drafted to deal with SA assets and a separate one to deal with international. Thanks, Priscilla. William, I think the next question I'm going to pose to you, because this is really a tax-related question, and it's a question that we actually get quite a lot as well from clients and from our colleagues as well, and that is around international investments. And if you do hold international investments and they're denominated in a foreign currency and you dispose of those assets, would the gain on such assets be calculated in hard currency, or how would that actually work?
Thanks, Tracy. In this case, the determination of a gain will be in hard currency, i.e., if you had bought Microsoft shares in dollars and you dispose of them in dollars, you will calculate the gain in dollars. Only the resulting gain will then be converted into rands at your choice, either a spot rate of the disposal at the date of disposal, or the average rate for your tax year end. So in this instance, really your movement of currency throughout the life of investment is not factored into your capital gain. So it's quite beneficial. Thank you.
Thanks, William. So indeed, that can be quite beneficial. We do have a question that's coming through here, which really touches on offshore joint accounts. And I think the question is it necessary to have an offshore will if one's offshore assets are held jointly with one's spouse in an offshore joint account? For example, a bank account or an online broker account. And I think, Hannity, what I'm going to do with this question is I'm going to just ask you, if you don't mind, because when it comes to joint ownership of bank accounts, I think we also do get often joint ownership, co-ownership, it's kind of used interchangeably. And perhaps you could just start in terms of this question, answering this question, but perhaps just start by briefly explaining the difference between the two concepts.
Thank you, Tracy. Yes, so those two concepts are in fact different in terms of joint ownership versus co-ownership. So generally the concept of joint ownership is used in the international context, and co-ownership in South Africa. So maybe to just give a brief explanation of the difference there, co-owners are each regarded as owning an equal share in the investment, and that share really forms part then of your estate as a South African and is subject to the normal estate administration procedures. Whereas joint owners, on the other hand, are each entitled to 100% of the investment generally. And a surviving joint owner would continue to enjoy such entitlement after death of another joint owner as a result of the right of survivorship. So this means that there are no estate or no probate needed upon the death of a joint owner, and that asset is not frozen in order to be dealt with through the estate. Instead, it actually transfers in terms of the right of survivorship. So in this question that we have on the chat box, it's really going to, on first dying, so in other words, should something happen to one joint owner, it's going to be transferred in a way automatically, but there is a certain requirement for documentation, such as a death certificate, but at least it doesn't have to go through the estate administration procedures. So there's actually no need for a will on the death of a joint owner. But keep in mind that if that's that second joint owner, or if there's multiple joint owners on the last dying of that joint owner, it must still go through the estate. So there's no right of survivorship because there's no joint owner left on that account. And in that instance, we would need to have a separate international will prepared. And we also generally also provide for, in that will, for simultaneous death of joint owners. So our advice generally to clients is to actually have that will prepared for all scenarios, although on first dying, the right of survivorship would be enforced. Back to you, Tracy.
Yeah. Thanks, Hanneli. So yeah, I agreed. And I guess the key thing as well is that if one wants to bequeath their percentage ownership in that account to someone else, then of course it would be important to have a will to deal with that. So thanks, Hanneli. Devs, I think the next question I'm really going to pose to you, and this is really around endowments. And the question is, endowments are an investment vehicle which holds significant benefits from an estate and tax planning perspective. But does an endowment need to be held in one's personal name in order to take advantage of these benefits?
Thanks, Tracy. So essentially, an endowment does not need to be held in your personal name. You can house an endowment in a structure like a trust. Holding the endowment in such a structure like a trust would give you the added protection from a continuity perspective, because on death, the endowment would not be disrupted. The trust can also exist in perpetuity, depending on the terms of the trust deed, and your endowment itself, being held in the trust, will not form part of a client's estate for estate duty purposes. Thanks, Tracy.
Thanks, Dave. Thank you. Akona, we've got another question that's come through on the tax-free investment account. And the question is, can you nominate a beneficiary on a tax-free investment account?
Thank you, Trace, for the question. So in terms of Section 12T of the Income Tax Act, a tax-free investment is defined as any financial instrument or long-term policy, right? So now what happens is that we have different sort of providers of tax-free investments. Usually insurers provide tax-free investment that falls within the Long-Term Insurance Act. As such, the client may be able to nominate a beneficiary, right? So on the death of the client, the proceeds from the tax-free investment goes directly to the beneficiary. However, it will still be subject to estate duty, but no executor's fees will be paid on that particular tax-free investment. So one of the sort of key things that one has to consider, if, for example, the limitations. So once the proceeds is transferred to the beneficiary, but the limitations will kick in, the annual limitation and lifetime limitation. So that could be sort of a negative tax consequence for the beneficiary, you know, paying tax at 40% on that tax-free sort of investment.
Great. So thanks, Akona. So it is really just important to look at the once again, the structure of the tax-free investment, because that will determine whether or not you can ultimately nominate a beneficiary. Akona, thank you for that. So just looking at the chat function here, I'm just quickly going through some of the other questions. Anonymous, who do I talk to if I want to draw up a will, and what costs am I looking at to run a trust? So I think just very importantly, if you do want to draw up a will, please speak to your wealth advisor. They will be able to assist you with that process. And if there are complex matters, they will then call in members from our team that are online today to assist them with that as well. What are the costs that I'm looking at to run a trust? And that's quite a broad question. It will very much depend on whether you're looking at establishing an SA trust or an international trust. But generally speaking, there would be an upfront fee that would be charged either to draft a South African trust deed, and there would be master registration fees, and then there will be ongoing trustee fees, because it is very important to appoint an independent and professional trustee on trusts, purely to ensure that you bring proper governance to the way those trusts are managed. And those will come with ongoing trustee fees as well. So I think if we can, just moving on, and I think there is another question here, and David, I'm going to pose this one to you because it's around trusts. I mean, everyone can answer questions on trusts, but what are the tax consequences upon winding up and distributing the assets from a trust to its beneficiaries? So presumably this would be a South African trust, but what would those tax consequences be on winding up and distributing the assets to its beneficiaries?
Right, Tracy. Typically, one should look at obviously the nature of the asset yet again when it's distributed or vested in the beneficiary. Now that the tax event with a trust is the vesting of the asset, and typically with the discretionary trust that would be the same. It doesn't have to always be the same, but it's normally the same if you want to wind up the trust. The decision by the trustees to vest the asset in the beneficiary and then also to transfer the asset to the beneficiary. Now, if it is a capital asset, that yet again becomes a disposal for capital gains tax purposes. And if the asset is then distributed or vested to a South African resident beneficiary, the conduit principle or the specific provisions provide that the capital gain becomes the capital gain of the beneficiary, and the beneficiary will be taxed on that capital gain. If the distribution is made to a non-resident beneficiary, then the trust remains liable for that capital gain at a higher rate. As we know, the rates for capital gains tax, or the inclusion rate and the ultimate rate, is lower with individuals. If it is income that is not a capital asset, but if it's income that's distributed to the beneficiary, the conduit principle provides that the recipient beneficiary will then be taxed on the income it receives. And that essentially would be the only taxes or the tax consequences. There could be, if you have a immovable property, for example, that's distributed to a beneficiary, and that beneficiary is related to the founder of the trust, and I think they said within the third degree, then the transfer of that immovable property will also be exempt from transfer duty. I don't know if anyone else would like to add something that I may have missed, but I think that sort of covers it. Back to you, Tracy.
Yeah, thanks, David. So I think it does cover it. I mean, I think so. Once again, I think really the answer to that person that posed the question would once again be to reach out to your wealth advisor so that we can actually assist you with determining what the exact tax consequence will be based on the assets that are held and the residency of the beneficiaries, etc. So another question, William, that's just coming through here, and this is more, it says it was mentioned that there's no flexibility for retirement funds, even provident funds. Could you elaborate on this, please? So William, I'm going to ask you, if you don't mind, to take that one.
Thanks, Tracy. Yes, as of 1 March this year, there has been a change in the sense that the Provident Fund and Provident Preservation Funds going forward have to be annuitized on retirement. However, it is important to just note that there are vested rights in the sense that any contribution up to the end of February this year are basically protected, meaning you could take them on retirement as lump sum, 100% of those, whether you were 55 or over 55 as of 1 March this year, you could still take them on retirement. However, any contributions to the Provident Fund going forward for anyone who is younger than 55 on 1 March this year will have to be annuitized on retirement. What does that mean is that only one debt could be taken as lump sum, and the 2 debts has to be used to purchase annuities, unless the minimum, the whole lump sum is really below the so-called de minimis, which is 247,500. Then in that case, you can take 100%. It is important to note that for people who were 55 or older, 1 March this year, they are relatively not impacted by these changes, meaning that on retirement, they could basically take the full lump sum as on retirement rather than annuitize. So they are largely not impacted. So that's really the gist of the changes. So you still have, I would say, the vested right, so you shouldn't worry. So that's really the summary of it. There are other finer details of it. Thanks, Tracy.
Okay, thanks, William. So just conscious of the time, because we are starting to run out of time. It's amazing how when you're having fun, how quickly time flies. And that's so true, because I can see that time is really flying away with us. But I do want to just try and answer 1 or 2 of the other questions that are also coming up. There's one interesting one, Ilana. I'm going to ask you, if you don't mind, if perhaps you could answer this one. If I win 71 million from Lotto, do I need to create a trust for it and a will instruction?
Thank you, Tracy. Yes, so first of all, again, we will have to look at when we talk about a will, absolutely it would be necessary for you to draft a will to stipulate what would happen with those proceeds once you pass away. When we look at a trust, it would also definitely be a consideration, but we will have to discuss with you, for instance, your long-term purpose with or intention with the funds. We will have to look at the estate implications of you receiving those funds, and we would look at your succession planning to find out, for instance, would be the ultimate beneficiary of your estate when you pass away. A trust in this instance could definitely, be something to consider. Thank you, Tracy.
Great, thanks, Ilana. And I am going to try and squeeze one last question in. And Priscilla, I'm going to ask you, if you don't mind, perhaps you could take this one. If spouses are married in community of property, are all their accounts deemed to be joint accounts, whether opened in joint names or not?
In South Africa, we don't have joint accounts. So although the Matrimonial Property Act would apply, you may have signing powers on that account, but it's not seen as a joint account. So that would be from a South African context point of view.
Thanks, Priscilla. Thanks, Priscilla. But obviously, if married COP, it would mean that effectively the spouses would own the account 50-50 in terms of entitlement, in terms of that marital regime. So thank you for the questions. And ladies and gentlemen, thank you. We do really appreciate all the questions. I do think we have managed to address most of them. And I think really just to try and bring it to conclusion now and to just bring it to an end, I think what is important and what I would like to leave with you is, as I mentioned in the beginning, at Nedbank Private Wealth and Nedbank Financial Planning, we remain committed to providing you with that globally integrated advice-led approach. And that's really designed to enable you to connect your financial decisions to your life goals and aspirations. We've also hopefully illustrated through the presentation that we've taken you through this morning that if you are looking to structure your wealth optimally, to structure your financial wealth optimally, it is important to consider the estate and tax planning consequences of any decisions that you make in that regard. And it's also important, just as a reminder, to continuously review any plans that you have in place. Circumstances change, and it is important to review them to make sure that you're still able to achieve those life goals and aspirations. So how can we help you? Well, it's quite simple. I think this morning you've got to meet the Fiduciary Advisory team. So you've met all of our team members, and we work very closely with your wealth advisor. So we really invite you to reach out to your wealth advisor so that we can really look at your personal circumstances and needs and requirements to make sure that you have a plan in place that will optimally structure your financial wealth. So ladies and gentlemen, just a reminder, you will receive an email in the next few days. It will contain a link to the recording of this session, so you will be able to watch it again or share it with friends and family. Your views matter to us, so please help us improve future webinars. Please provide us with your feedback in terms of this session, whether you found it useful or not. So please do give us that feedback, and please remember that you can get other thought leadership insights by visiting our website. We have the recording of all our previous webinars there, and we also have a list of upcoming webinars, so please do visit our website. So lastly, but by no means least of all, ladies and gentlemen, thank you so much for connecting with us today. We do hope that you found this session to be useful. And until we connect with you again, please go well and stay safe. Thank you.